When a bank fails, the first step is typically for regulators to take over the bank's operations and try to stabilize its finances. This can involve injecting capital into the bank, selling off assets to raise cash, or negotiating with creditors to restructure the bank's debts. In some cases, the bank may be able to recover and resume normal operations. However, if the bank's financial problems are too severe, it may be declared insolvent and forced to shut down. In this case, the bank's assets and liabilities are liquidated, which means that its loans are called in and its deposits are repaid to depositors. If the bank's assets are not sufficient to cover its liabilities, depositors may lose some or all of the deposits. To protect depositors from losses, many countries have deposit insurance schemes that provide a level of protection for deposits up to a certain amount. In the United States, for example, the FDIC provides insurance coverage of up to $250,000 per depositor per bank. In other countries, the level of deposit insurance may be higher or lower. The failure of a bank can have broader implications for the economy. If the bank was heavily invested in certain sectors or had significant loans outstanding, its failure could lead to a decline in those sectors and potentially trigger a recession. To prevent this from happening, governments may step in to provide a bailout or other form of financial support to stabilize the economy. In some cases, the failure of a bank can also lead to a loss of confidence in the broader banking system. This can cause depositors to withdraw their funds from other banks, creating a run on the banks and exacerbating the financial instability. To prevent this from happening, regulators and governments may take steps to reassure the public and stabilize the banking system, such as providing additional liquidity or guaranteeing deposits. Troubled lender Silicon Valley Bank has been closed by the FDIC after deposit outflows and a failed capital raise sent the firm into crisis this week. In a statement released late Friday morning, the FDIC said, Silicon Valley Bank, Santa Clara, California, was closed today by the California Department of Financial Protection and Innovation, which appointed the Federal Deposit Insurance Corporation, FDIC, as receiver. To protect insured depositors, the FDIC created the Deposit Insurance National Bank of Santa Clara, DINB. At the time of closing, the FDIC as receiver immediately transferred to the DINB all insured deposits of Silicon Valley Bank. Shares of the bank's parent company, SVB Financial, SIVB, remained halted for trade on Friday after having lost 60% on Thursday and another 60% in pre-market trading on Friday. The FDIC statement continued, all insured depositors will have full access to their insured deposits no later than Monday morning, March 13, 2023. The FDIC will pay uninsured depositors an advance dividend within the next week. Uninsured depositors will receive a receivership certificate for the remaining amount of their uninsured funds. As the FDIC sells the assets of Silicon Valley Bank, future dividend payments may be made to uninsured depositors.